all thinking, well, you've got better things to do probably than looking at broadcast, but you're probably thinking, how might you sort out your investments for next year? And that's what I want to do with this. And that's why I've done the broadcast this way, and what I'm showing you and what I want to go through. I won't take up much of your time. But the reason I thought it'd be useful is because I have a lot of family members saying to me, listen, I want to sort out my investments for 2021, stock investments, and especially for their SIPs, 401ks, and ISAs. So whilst I'm doing this broadcast, feel free to ask me any questions as well. And people are obviously very motivated at this time of year as well. The reason they're motivated is they've got New Year's resolutions. They want to make a clean start. Obviously, with everything going on in the world, they might be concerned about their financial future and are they making enough of their capital. So I want to teach you a few things about investing from decades of research which has been done. And I'm going to share that research with you. But not only that, from all the research I've collated from, you can see my books over my shoulder, from all my own books that I've authored on the subject, and my 200 FT columns as well. So I'm going to put all of that in to this quick presentation, which I want to give you. Now, first things first, if you do make money out of investing, as I've been fortunate enough to do, please think of greater causes as well. I try and do this in all my talks, is try and let people know there are bigger things out there. For me, it's the Lumbar Trust, of which I'm co-chairman. It was set up by Lord Lumbar. It looks after widows and orphans. So that's a quick plug for them. Do think of good causes you yourselves might want to promote and be focused on. I'll focus on the important bit, which is that bit, not my face. Okay, and looking and sort of going forward on that theme of now moving into the investment, the key reason people find it so difficult, the key reason investing is considered so difficult by so many to do is because there's so many factors out there. So let me tell you what the research shows. Now, the first approach I'm going to suggest you do for this year, whenever you're looking at investments, you're going to get a lot of noise thrown at you from a lot of different sources, is I want you to filter. Some factors are more important than others. I mean, look at all the factors you could have when picking any particular stock. It's incredulous how much stuff is out there. You've got all these valuation metrics. You won't even probably know what most of these mean. You've got the growth factors of a company as well, sales forecasts, earnings, cash flow, profits, price earnings ratios, price to book ratios, price sales, discount cash flow. How on earth do you do it? And of course, at this point, people throw up their hands and they'll say, oh, I'll just give it to a stockbroker or a financial advisor or a fund manager. Don't. And I'll show you why you should be managing your own capital. I want you to spend the next few minutes learning the broad brush stuff from me, and then at least you'll have the right questions you can ask experts if you do happen to use them. But please don't just entrust your capital to the experts. It's your money. Nobody cares about it more than you do. So you need to know the bare basics, which is what I'm going to teach you. And I'm not going to bore you with saying, well, this is what a dividend yield is. What I'm going to say to you instead is, guess what? A lot of research has been done. I've published it in my Financial Times columns. A lot of research has been done which shows that certain factors are more important than others. Now, we, of course, know an undervalued company is better than an overvalued one. We, of course, know a high growth company, all other things being equal, is better than a low growth one. Research proves that. Of course, there are outliers. We'll sometimes see overvalued companies with next to no growth and their share price skyrockets. Well, that's gambling, and we don't want to do that, okay? On the whole, we know there are certain things which are more important than others. We know companies which pay dividends, on the whole, tend to, on the research, do better than ones which don't. Ones with some momentum tend to do better than ones which don't. But the mistake people classically make is they will focus very often on just one factor. Don't do that. They'll say, oh, this is an undervalued company, which is why I bought it. That's not a good reason, okay, to invest one factor alone. So if we know there are a multitude of factors, and I've just listed some of them, including things like the company size and insider buying, what does the research show? And you better believe people have researched it. There's trillions at stake. Of course, they've researched the hell out of it and what is important and what isn't. So let me go into that. For instance, and I'm no connection to this particular company, but they're one example of a company who's done the research, and it's a 60-page report. I've used it in my Bloomberg TV presentations. I've used it in my books. It's just one of many research reports out there. There's been others which have been updated by Citibank, for instance, since then. What has worked in investing? Studies of investment approaches and characteristics associated with exceptional returns. Of course, somebody's done the research. What does that research look like? What are these factors? Now, the reason I'm mentioning this is so you don't do the classic mistakes that people often do is they'll get a magazine and they'll go, oh, yeah, that's a good journalist story. I'll just invest in that. Of course, the journalist's job is to get you to read their article and believe it's convincing. Okay, they've got to use clickbait to do that. That's not a good way to invest. Journalists' comments are not a good way to invest unless you want to speculate, and I suggest you don't. So what the research shows, I'll just dip in a bit about what kind of stuff the research shows, is they broke it down, as you'd expect, by looking at not just specific factors like valuation, but then breaking that down. Well, what level of valuation and what kind of returns might a company generate from the variety of different valuations? Now, there's no one single answer. I mean, of course, guess what they found? 28% return on average if it's or 30% if it's undervalued. Price to book value. No, so what the hell's book value? What's share price? Leave that to one side for a moment. My point to you is this. Within each of the main pillars of investing, there are subcategories, and certain things are better than others. So how do we know what they are? And how do we, most importantly, throw out stock names which tick all these boxes? That's what I'm going to explain to you. I'm just showing you where the background on the decision is made. A bit like when countries do COVID lockdowns. They say, we're going to have a lockdown. Here's the research. Nobody reads the research. I'm going to give you a bit of the research so you know why the outcome is the way it is. And like I said, this is what proper research looks like. I'm afraid it's not stock tipping magazines, okay? Proper research tends to be pretty dull. It tends to be with titles like The Importance of Dividend Yields in Country Selection, in the Journal of Portfolio Management. It's not in, I'm sorry to say, in your average W.H. Smith's stock magazine or in the Sunday papers. Okay, so what does this kind of research show? Again, it shows countries which tend to have high yielding indices tend to perform better. So we want to know, well, okay, that's all well and good. But for today, Alpesh, for right now, what does that mean? Which are those countries? What's going on? Which ones are doing well? Let's add to that. This is stuff which, like I said, I've published before, but what I've realized is, of course, nobody sits around reading my Financial Times columns or my books. So I thought I'd better just do the broadcast of it as well. You thought nobody's researched this. You're wrong. People have actually gone into individual countries and they do this each year. So we need to know for 2021, okay, if these are the things that I hadn't even thought of, the unknown unknowns, the things I hadn't thought of, which are important. And I'm not just saying this now as we approach 2021. I've been saying this since 1999, since the last millennium. Okay, that's my very first column in the FT. And you can see there, I said I'm moving into US stocks is the example I gave then. And the reason in 1999, well, if you've got a time machine, I bet you wish you could have done all of that as well and diversified into that. Why? Well, because this research had already existed and proven what to do. I'm not saying we just buy US stocks. I'm saying we're going to now have to drill that down to get our 15 stocks in a portfolio for a 12-month outlook, which meets certain criteria, because we know that those with lower price earnings ratios tend to have higher compound annual rates. But we also know that's not the only factor. We know that's not the only factor. We know there are other factors there. So what we do is we filter for those. And this is what I want you to do. I don't want to give your money to somebody else. I want you to be your own fund manager. I want you to find the ones with the best valuations and then the best growth, and the best dividend yields, and the best cash flow. And we're going to look at this because the research shows it time and time again. Now, the unfortunate thing is very often wealthy people will give their money to a UBS or a PIMCO or whoever, or Goldman Sachs, and that's entirely up to them. And they share all that information and know-how and the academic research and all the rest of it. You can see here on my terminal, it says UBS rich clients get Goldman PIMCO strategies with no extra fees. Great. Well, you don't get that, do you? Oh, by the way, you can see Lam Research there. I should say I'm a shareholder in that. That's not a subliminal message. I am a shareholder in Lam Research, and I continue liking that microchip design company into 2021. It's $1 billion company. Whoever you are listening to this, you are not going to move the share price on the needle by me mentioning it. But my point is, so how do we tap into that kind of information? I mean, UBS will send out their year ahead for 2020, and they'll do it for 2021. Goldman's will send their conviction lists and the like, and you don't get access to that. And I don't think that's fair. I think there's a case to be made for a Robin Hood. I don't mean the broker. I mean Robin Hood, as in getting that information and passing it. So let me tell you what the research points to, and whether it's a JP Morgan's guide to 2020 and the markets. And I've been giving this information as sort of mini Robin Hood, if I may, since 99. That's me in 99 on my show on Bloomberg with Sally, and then that's on Sally's show on the BBC 21 years later. The point of it is valuation, and we want to filter for the lowest value, highest growth, income, so VGI, income, value growth income, momentum, M for momentum, okay, C for cash flow, and we're going to look at the specific method of measuring cash flow. And on top of that, we're going to look at Sortino and Alpha as well. And you're going to think, what the hell are those? Well, Alpha is outperformance of the market, and Sortino is going to measure a good average return each year with a low volatility distribution. Only when we filtered across every single one of those would we consider the equities. Now you might say, well, wait a minute, that would mean you missed this company and that company and that company. It doesn't matter. Think of it like football teams. You can win and beat everybody else, but you don't need to have all the best players in the world in your team. It has to be as a portfolio of 15 stocks held for 12 months, because I'm keeping it simple for you. And there's a big reason to do this. That's the difference. Look at that. That's the difference with getting it wrong. And countries, I'm just looking at specific countries. And within those, we're going to drill down and filter and filter. If you do not filter for purity and performance, you will mess it up. If you only look at a journalist comment which focused on one little thing, then you won't know when to exit. You won't know about all the other 360 degrees that you should have been looking at. And the poverty gap is massive. For this year alone, the difference between, say, the UK market and a measure of the American market is over 55%. I'm 55% richer than all my UK friends, because they tended to track as an average. I'm sure some did worse than an average and some did a bit better than average. They will have tracked their domestic market, because most people give their money to pension fund managers who track their domestic market. Assume, for instance, over the next 10 years, and just to show you how important this is, let's say you do get it right and you get towards what I think a private investor should be targeting is a 20% return. Now, they're not going to get that every year. And there is risks associated with owning even a Microsoft. If we think of Microsoft as the safest company I can think of off the top of my head, then you will have seen it fell in February and March, right? So we're not about a bank account. So if you can't handle that, then you shouldn't be investing at all. But let's say you can and you're an investor, okay? Then we're going to look at a certain return which isn't too extravagant or too pessimistic. How much that can't be achieved? Well, actually it can, because if an index can do it, individual stocks certainly can. Not every year, but we're talking about an average over 10 years, okay? And we're not going to just track an index. We want to outperform it. How are we going to outperform it? Well, we're looking at valuation, growth, income, momentum, cash flow, because the academic research shows if you use each one of those, then you outperform the index, right? Cash flow, Sortino, and Alpha. So we should be outperforming it. And we've got the advantage of picking global equities as well. So let's say you've got 100K in your 401k or SIP or ISA, and you also plan to add 1,500 each month. Now, you might not. You might say, I've only got 10% of that. Well, reduce everything by 10%. Well, over 10 years, you'll have £1 million. 100 will become 1 million in 10 years on those figures. And that's what it looks like, okay? 100,000 becomes 1 million. And that's you. There's no fees to pay, because you're the one who's managing your own capital. You're not paying a fund manager. I don't want you to pay a fund manager. I want you to learn how to manage your own capital, or at least know what the hell's going on, okay? And especially in 2021, because I think it's going to be a good year given the amount of monetary and fiscal stimulus coming out of central banks coordinated around the world. Never seen anything like it at all. So there you go. Okay, that's that part. But let's say you are more modest, or let's say you're saving for your child's ISA, so it's tax-free, all these returns being tax-free if they're in a tax-free wrapper. Most governments and countries have them, ISAs, 401ks, and so on, and SIPs. So let's assume you've only got 10K instead, and you plan to add 6,000 a year. Divide equal each month, that's 500 a month. Or you might just put it in a lump sum at the end of the year. And let's say you still get the 20%. You're the one. So we're going to have to find stocks which are undervalued, higher growth, good dividend yields, cash flow, okay, and Sortino and Alpha. How are we going to do that? Well, that's what happens to that cash. You stand with 10,000, you end up with 600,000. This, by the way, is the chart that I'm projecting for my son, who's currently 2.5 years old. And this is where he is on the graph. He's only down here, of course, but he's on target, right? And you can see how it compounds away and accelerates later. But because I don't want to mess this up, I'm going to make sure the kind of companies I have, I'm going to just throw a bit into Bitcoin and Tesla. It's too volatile. I want to try and get this right. I'm a sort of slow and steady cricket player type of person. We're going to make sure that the kinds of companies that he's in are the well-valued, so cheaper, not necessarily cheap, but cheaper, higher growth in terms of earnings and revenue. And each year that's got to be done. And the numbers I want you to remember are 12, 15, 25, and 40. 12 is 12 months holding period, then review for a new set of stocks, which might include the old ones. But 12, 15 stocks, that's ample diversification for most people. Statistically, it's proven. 25 and 40, well, 40 is what I target because I own global stocks. If it was only UK, it'd be 20. If it's US and global, then it's 40% per annum. But if I get half of that, I'm happy because that projection is based on getting half of that. Okay, so what happens if we narrow that down a bit? What happens if we get into some of that detail? Well, first thing I want you to do is keep it simple. Like I said, 12, 15, 25, 40. 12 is 12 months. You could argue the toss should be 11 months or 13, but I'm giving you 12 because there is some research behind it that the fundamentals of a company apply over 12 months, not over one day and not over 50 years. They apply over 12 months, okay? Because new news is always coming and different things happen in the world. 15 stocks, ample diversification. You can argue the toss with me. What if they're all tech companies? Well, when the markets fall, everything's correlated, okay? Real estate and tech is correlated. And when the markets don't, well, an Apple and an Amazon, you'll be surprised. They're both in technology, but they're not very correlated. Not as correlated as you might think they are, okay? 25% is if a stock, after you've bought it, drops more than 25% from the highest it's been, then you sell it. Why? I'm keeping it simple for you. You can tweak that rule if you wish. I'm just trying to keep it simple for you. And 40 is the targeted return that I am going through. Now, the reason I want you to manage your own money, I want you to do it. I don't want you to listen to magazines. I certainly don't want you to listen to stockbrokers. Because if there is a hierarchy of people who know what the hell they're doing, well, I might say the academics and the hedge fund managers are near the top, okay? And right down is self-evidently is going to be a stockbroker who's just been told, you know, Jimmy, you're out of university, you did economics, write an article about why you should be investing and what you should invest in. Or a journalist on an internet site. Oh, yeah, just pick a company, you got 500 words to fill before you can go home. That's not the way to do it. And fund managers get it wrong for a very simple reason. First of all, they've got fees, which are killing things. They've got a lot of capital under management, not because they're good, but because they're good at marketing. Fund management is 90% marketing, okay? So once they've got all that capital, they've got to subdivide it into lots of different funds, like Japan Growth, UK Income, right? They're almost sort of playing bingo with the words. Let's put in a country, then let's put in a strategy type. So you'll put UK Growth, you'll put Global Value. But they won't just say, we're just going to pick the best of the best and we've only got one fund. Why would they ever do that? They'd be underselling. So I want you to be your own fund manager. Like I said, there's a huge poverty gap of you not doing it. Over the last 5 years alone, the difference between just tracking, and this is index tracking. I'm not even talking about individual stocks, which is what I want you to do. If you were just tracking an index, the poverty gap between you and then, for instance, somebody in another country like the United States is 140%. They've more than doubled their money and you've lost a bit. Well, you can see how people, even if they're doing the same job in two different countries, one's getting richer and the other one isn't, simply off the labors of the companies that they're investing in. And it's not that they've invested in higher risk companies. It's just that they've put their capital into their domestic index. You put it into yours. You were born investing in the wrong indices often. So we need to drill those stocks down. So let's do that. Now, this is a typical bad portfolio that I see. I get students or apprentices of mine coming to me and they're saying, Alpesh, have a look at this. What's your view based on the education that you are providing us in these talks? And I'll say to them, well, why the hell did you pick these companies? Given Sortino tells me that they're more volatile than the returns they're giving you. So their average return is low. Their volatility, in other words, the likelihood of them giving you a loss is high. They're overvalued, low growth companies, which aren't paying good dividends compared to their peers. They don't have strong cash flows on top of all of that. And they're underperforming the market, and you can see the performance. It's this. So I asked them, what the hell? I mean, you could not have picked a worse batch of companies. I said, why did you pick these? And they'll often turn around and say to me, oh, well, some of them did well once, about 10 years ago, for a couple of months. Or they'll say name recognition, or they'll say, oh, journalist mentioned it, or brother-in-law mentioned it. It's usually those things, one of those four things as to why they're losing 40, 50% in a very short space of time. And you might say, oh, poor guy, the market's fallen. Actually, no, it's not. There are numerous markets around the world which are at all-time highs. So I'm sorry, that's not an excuse to have poor performance like this. The reason is people tend to invest by name recognition in their domestic markets, which is not a bloody good way of doing it. On top of that, they'll then say, well, forget it, Alpesh. The answer is quite clearly give it to a fund manager. And the funds will have sexy titles like equity, growth fund, and 8 out of 10, 5 diamonds and the letter A, and yet they'll generate negative 2% return over 3 years. Well, if you know anything about what's happened in the world over the last 3 years, despite COVID, the markets have been hitting all-time highs. So how come rubbish fund managers like this can't do it? Okay, well, one reason is they take 10% of your capital every 5 years. That's a screenshot from what that fund manager actually did. Took 10% of your capital. Okay, took 10% of your capital. There it is. You can see it on screen. Took 10% of your capital over 5 years. You gave them £10,000. That's what they do. Well, no wonder they're underperforming, because on top of the restrictions they have by country and strategy style, they've got to keep taking the cash flow out. Their job is to act like a vampire, suck just enough blood out of you to keep you living, right? Not kill the patient, and make sure they walk away in their Armani suits or whatever the hell the cool kids wear nowadays. So the other problem people ask me is, well, what about when to sell? Like I said, 12-month holding period, or if it drops 25% from the highest it's been since you bought it. Now, I have multiple strategies. I'm going to teach you one or two of those right now. I will want stocks because I filter. I want not just valuation, growth, income, cash flow, Sortino alpha. I also need to see if those names keep appearing over and over again in all of those criteria. So I will look at hedge fund ownership reports, not because I think hedge fund managers are the greatest thing in the world. I do, but that's a side issue. But because if the names keep appearing in the buy list and not the sell list, the chances are there's millions of dollars going behind them. And if they're then undervalued, and growth and cash flow and all my other criteria, then I've mitigated my risk. Yes, I wear 6 belts and 6 braces. I'm very belt and braces. I do not gamble with my pension or my son's inheritance, okay? Similarly, I will look to see if there are certain hedge funds which are doing rather well and what do they own. So for instance, Mr. John Kim of this one, I don't know who he is, by the way, I've never met him, 51% per annum over the past 3 years. He might have got lucky. Doesn't matter. What matters is other names keep coming up. It doesn't mean I buy it just because he's bought them. No, I need these names then to have come up in my other criteria, valuation, growth, income. Now, the reason I'm telling you all of this is because I want you to be aware as you look into 2021 that whatever approach you're using, if you're using journalists, if you're using just giving it to a fund manager, you're being oversimplistic and it's going to blow up. And that's what worries me. Okay. So I'm giving you this for that reason. The reason I say 15 stocks, I've shown this chart before. These are some of the biggest billionaires in the world. Bill Gates, Bill Ackman's a hedge fund manager, George Soros, Jim Simons, hedge fund manager, Leon Cooperman, Warren Buffett. Okay. Look at the number of stocks they got, with the exception of Simons, who's a hyper fast trader, so ignore him. 10. Bill Ackman, he's got $6 billion under management and only 10 stocks, and his top 10 holdings, well, by the time you get to his 10th holding, he's hardly got any money in it. In other words, they don't have hundreds of stocks. So 15 for you, unless you've got more money than Warren Buffett and Bill Gates put together, will be enough. Okay, and it's not enough to know what they've bought. A journalist will say, "Oh, Warren Buffett just bought General Motors." That isn't enough. What matters is, well, how much, and did other people do it? Maybe he just reinvested dividends. Who knows? Okay, so if their impact is very little, then what the heck does it matter? So what we do is we then put that all together in terms of everybody. That's how I got into United Healthcare, which, by the way, I still own. Yes, of course, I own Amazon, but I've got that on 2 times leverage for Amazon, so I really like it. Anyway, that's a separate issue. So we look to see, is this being replicated? So when we're filtering, are we seeing it as coming up again and again and again? Are the names coming up on the buy lists, not the sell list? Okay, now I'm going to go through every single strategy, but the reason I'm giving you this insight or lifting the lid is so you can see the level and the standard you need to maintain. So for instance, you might say, well, I'll just do an index tracker. I'll just do qual, which is quality stocks, supposedly, and it just goes up and up and up, and I'll just put my feet up. Well, you'll be underperforming the market or what you could have done, because whilst they've got stocks like this, top 10 by weight, unless you drill down and actually look at the ones which are adding to their contribution to their returns, you'll be underperforming because you could have done better. You could have just bought the ones which are outperforming and showing good valuation growth income and so on. I own Declaration of Interest, Microsoft, Apple, MasterCard from that list anyway. There's also a whole bunch of things in terms of what are the big banks telling their wealthiest clients. Now, we don't just look at, sometimes people say, and this is in April what I did, now we're coming into 2021, this is what happened. This was Citigroup. And the red line was all the major banks' average analysts' forecasts, which are always over-optimistic. Look, you can see it. They're always higher than the price, and they're always over-optimistic. But when the price of Citibank was at 42, sorry, Citigroup, at 42 back in April, we said, well, probably go closer to 70 because the target was 78. They're over optimistic, go to 70. That's a 50% return. Not because we only looked at this. I've just said it needed also to be on the guru's list. It had to be on valuation, growth, income, cash flow. If you only did one thing, and that's what journalists do, they'll go, oh, XYZ broker has just done this upgrade. That's not enough. That will be nowhere near enough. You are gambling and speculating, okay, if you're doing that. This is Capri, and you can see it was in April. We did the screenshot from when I did my broadcast then. In April, we said it could go from 12 to 30 because that was the average analyst. Plus, it was on our other filters. It was on our other filters. Today, it's at 42. That's a 250% return. So you might ask, well, why didn't you just put all your money in that and nothing else? Well, I wish I did that always in hindsight, but you don't. Nobody ever does. Today, I'm sure I'll regret for next year not putting all my money in Tech Target or Square. Okay, I'm sure I will in 12 months' time, but I don't take that level of risk. That's why I have 15 stocks and not 1 or 2. By the way, this is not to say buy Capri today. I'm sorry, it's too late. It's already happened, okay? It's too late. Disney, my sister wanted to know for her children's school fees what would be a good one, and she's a sister, so I thought I'd better really be on my game. That was a 73% return. That's not because I'm picking this. I'm not. It's too late for me to give you this now. I'm saying to you, the approach you need to is, have you checked on your Excel spreadsheet checklist, valuation, growth, income, momentum, cash flow, Sortino, alpha, and has it appeared in guru lists and analyst upside? And the analysts are not stockbrokers at, I don't know, Hargreaves Lansdown or something. They're going to have to be proper analysts, the ones who can actually control trillions. And I'll tell you the kinds of ones we tend to focus on, but they're not the only one thing you look at. You can't ever look at those, okay, either. In March, I said it can go from $27 to $43 in the case of Uber. You know, how crazy were we? That's the March thing, and you can see it there. Today, it's at $50. We're not in Uber anymore, okay? Just so you know this. We're not in Uber anymore. But that's what had happened. That's because it also happened to hit the valuation, growth, income, momentum, cash flow, all the other factors. Viacom's another one that was 190% return. Similar approach, not just the analysts. Please, please, please. So when you read these journalist comments, you're going to see them all. You're going to see all these headlines now coming at you from the newspaper saying, hey, what to invest in 2021. Please make sure you checklist against valuation, growth, income, and all the other facts and the guru holdings. What you all want to do is you're going to ask me, oh, no, but I only want to do one thing. I only want to do one thing. I've done some of the slides before. Somebody's just asked me, and some of them are new. You might have missed some of the earlier ones. Some of them I've done before, some of them are new. In March, I said, in the case of United Health Group, which I still own, and that's given a steadier return. It's more a plunky fat stock. Okay. So let me just tell you again. You'll hear you'll read something in the newspapers, or and you'll say to yourself, you know what, Alpesh, I'm going to, Ramsey at Barclays has upgraded a stock. That's not enough. Okay, any given stock. So the job of my team to tell me, first of all, which bank, how big were they? What's the track record of Jason or whoever the hell it is? How big's the price target and how recent was it? Now you think about it, if you're creating an algorithm for stock selection, you'd need to know how much money, how much weight, how much track record, how big a target, and the recency. Those would be obvious factors. Imagine you got a job interview and I say to you, how are you going to analyze analysts to determine whether or not to buy a stock? If you didn't mention those factors, you said, well, I'm just going to go on the internet. You're getting sacked, right? You're not even getting hired. My point is, we'll give extra weight to certain of these. So when you read in the newspapers, analyst upgrade, please ignore it unless you have managed to look at all the analysts and the biggest ones and the target and the size and the valuation and the growth and the income. Because if you leave one or two of those important pieces of information, you're gambling and speculating. Okay, you're gambling and speculating on that. The big one that I want to reiterate is this, and I've reiterated it before, so some of you might have seen this before, and I can't say it often enough. Goldman Sachs Asset Management happened to use a particular formula in order to advise their wealthiest clients on the stocks they should be looking at. This is the formula. It was devised by Deutsche Bank. It's now used by Goldman Sachs Asset Management. This is one of their slides, okay? And what they found is stocks with the highest cash flow, okay, cash flow, there you go, cash flow, stocks with the highest cash flow tend to generate about a 30% return. Now, we're not going to put it into a basket of stocks. If we did, we'd get 30%. Once we get that cash flow basket, we then want to look, as the research shows it, as I showed at the start of this webinar, shows it that actually the companies which are then undervalued as well, with higher growth and dividend yields and momentum and Sortina and Alpha, will do even better than the 30%. So it's not just looking at one factor. And that's really difficult to try and get out of people's heads. See, everybody always wants to look at just one factor. They'll always turn around and say, oh, gurus, I didn't know that's there. Oh, I'm so excited. Or they'll go, oh, artificial intelligence. One factor will not do it. Imagine you're picking a spouse. If you based it just on looks, you're speculating, you're gambling, you're going to get lucky, and you don't even marry your stocks. Okay, so remember, 12 months is how long you can hold them, 15 stocks, 25% they drop from the peak. Why 15? Well, this is a good rough and ready reckoner. Now, the funny thing is, we can argue the toss about correlation diversification and sectoral diversification versus market and country and blah, 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 blah. I'm trying to keep it simple for you. 15 will do, okay? It really will. Probably my favorite strategy is this one. You're not going to do this one, but I'm just telling you, and I'm going to mention some more names of what I happen to hold. And everything that I hold, on the whole, I think pretty much the companies I'm mentioning today are all billion-dollar companies. So you're not going to move the dial on making them go up. I'm not mentioning any penny share stocks, which will go up if I mention them. It's happened on TV before. And anyway, so I do 2 times leverage. Now, this is more sophisticated. This is more for the geeky ones amongst you, okay? I'll do 2 times leverage on any stock which has this kind of return distribution. Past performance is no guarantee of the future, obviously, but if a stock has this kind of return distribution where it has a high average, a high mean, and a good a diversification which is generally positive and a diversification which isn't too wide. In other words, the volatility isn't too great, the average is quite high. Put in other words, it's got a good likelihood of also beating the market. So strong alpha, strong Sharpe ratio, strong Sortina. These aren't the only factors, but this is what I look for. Now, I will then do a 2 times leverage, not 200, not 500, 2, and that's it. If you want to blow your investment portfolio up, do more leverage. Never mistake leverage for genius. Okay, never mistake a bull market for genius, as a lot of people have done in the last 12 months. And certainly don't mistake leverage for genius. All right, it isn't. Men tend to be more, the research shows, tend to be more egotistical and have self-attribution bias than women. So men really will use the size of their leverage to boost their ego and claim that it was all them. Honestly, leverage is a double-edged sword. It's not genius. So why would I use it on something like this? Well, because as you can see, it's positively skewed. Okay, the statisticians amongst you, kurtosis is positively skewed with a high mean, high peakness. Okay, so there's very few companies which do this. Danaher, Dollar General, Costco, Microsoft tend to have similar distributions like this. And it's one of the reasons why I do, Marianne, I'll answer that in 1 second. One of the reasons why I do 250 days. Why 12 months, Alpesh? Okay, well, because look what could happen over 20 days. I don't want to double leverage over 20 days. Spread betting companies want you to do that. Of course, they bloody want you to do that. Look at that. They're almost guaranteed you're going to blow your head off and panic and get a margin call, and they're going to take the other side of the money. Okay? No, we'll wait. Because we're talking about investing anyway. Anyway, this is what it looks like. This is what I'm saying is the standard you got to raise it to, because it's your money in your pension pot. And if you've not raised it to the standard of looking at the valuation, the growth, the income, the cash flow, the momentum, which is the return over 6 months is a good proxy for that, Sortino and Alpha, you're speculating, you're gambling. And your stockbroker certainly is, and the magazines you're reading certainly are. And that's been the key reasons why, all those books, I keep on repeating it, keep selling around the world, because people don't listen. They buy the books, they don't read them. We all know that. They'll watch the webinar, they won't listen. Marian asked about Airbnb shares, a good investment. On the whole, I tend not to go straight into IPOs. That's no offense to Airbnb, and I've written articles about IPOs as a general rule. The reason I don't is because the amount of information once they're public is obviously limited, because they're not public. There's only the private information. So don't let that put you off. It's just me saying I don't do that. But that doesn't mean it's bad. It's just that I don't do it. Okay. So I'm the wrong person to ask. It's like if you said to me 2 years ago, should you get into Bitcoin? I'd have nothing intelligent to say. I'd say, yeah, toss a coin. You might make lots, you might lose everything. So I'm not a cryptocurrency specialist at all in similar way. I'm not saying Airbnb and crypto are the same. So I can't say anything intelligent about Airbnb, I'm afraid. What I'd say is, summarize what I've just said, 12, 15, 25, 40, global stocks, monitor them frequently. Don't keep looking at your portfolio. It's like lifting up your roots, okay, in your plants, you'll kill them. One screen, not one strategy. It's got to be valuation, growth, income, momentum, cash flow. 20 investments, 15 to 20. This, by the way, it's the same approach I've used since I looked like that. Okay, sorry, I look a bit of a dick. That's me at my last exams, and a very long time ago, as you can tell from the gray hair. So I've used the same approach. So I'm keeping a consistent message from that 1999 column in the FT to winning the competition in the FT to forecast the markets as well. All right, to everything that I've written about as well. Okay, so, and I've got some credentials to back it up. So I'm not just telling you this stuff and having made it up in 2 minutes. I'm telling you because there's a track record which goes back 21 years. I want you to do it. You manage your own capital, okay? You manage your own capital. Now, some of you might have joined in a bit late, so, and because you've said, oh, is this the same material as before? Some of the back end stuff was. Let me just go back right to the front really quickly, okay, and tell you the bits that you haven't possibly seen. And by the way, if you want that research report, it's not been done by me. The academic research was done elsewhere. What I did is I've used it in my books, but if you want this one, I've got no connection to Tweedy Brown. I'm not endorsing. I don't know who the hell they are. But they're one of many who've done research reports. So if you're particularly interested in a 60-page research report and what's worked in investing, and theirs is not the only approach I've used. I just used their research. You can get it from my website, alpeshpatel.com. There's 3 buttons which says free this, free that, free that. Click on all of them and you'll get access to everything. This, my Telegram channel, everything else for free. The point is, this is the kind of research they did. They're not the only ones. I've got other academic research as well to back it up on valuations. What works? Okay, what generates 30% return and what generates half that? Okay, so it mattered. And that's why we looked at those criteria and why we look at all of those. And we don't just look at one thing, we look at all of it. So for instance, there's this research out of the Journal of Portfolio Management. You're not going to read that, obviously not. But the point is, all of this is based on strong academic grounding, not just, hey, let's have a punt and try it. Okay, and it's based on the strong academic grounding of research, which shows each of these factors is important, but they have different weights. And those weights can differ at different times, which is why we don't have just one stock, we have 15, and also why you review it every 12 months. Okay, because things vary. Okay, hopefully all of that was helpful to get you set up for 2021. Happy New Year, and safe investing out there. Like I said, the report's freely available, as is a signed copy. Sorry, not a signed copy, as is a copy of my book, Investing Unplugged, which goes into a lot more detail in all of this on alpeshpatel.com. There'll be a picture on there. There's I'll just show you, because some people then email me go, can't find it, which worries me. There we go. So if you go onto alpeshpatel.com, you'll find it there where it just says free. So click on that one. Do that as well. I recommend it's free as well, because you'll get daily updates. And if you really want to learn, there's free videos that I've put together as well, based on all my books, because nobody reads books anymore. So we converted it all into videos, because apparently that's how people want to learn. Okay, thank you all very much for listening, and really appreciate it. Thank you.